the advocacy series, which we have held the first and the second, and this is the third, is actually to address critical issues that are affecting the business of banking and finance in Nigeria. We are looking at major banks, businesses, and the economy. It is the objective to propose economic solutions that have implications for businesses and policymakers. This idea is also aimed at providing ideas that can help Nigeria as a country to respond effectively to all the multidimensional challenges confronting this country. We hope to generate insightful ideas that will assist us post-COVID-19 pandemic, and also come up with messages of hope that will help minimize the anxiety, as well as amplify the excitement of our numerous stakeholders, including all of you and beyond. One of the reasons why we chose today to x-ray the current policy issue on non-performing loans and the Global Standing Instruction, GSI policy. What are the impacts and what are the insights for financial stability? Ladies and gentlemen, you permit me not to take the center stage because we have brought people that are very, very on top of this policy, and of course have knowledge of what is required. So, a man of so many parts and one of the brightest brains in the field of economics, strategy, and consulting in Nigeria and across the globe, the chief idea and architect of BA Associates, Dr. Biodun Adedipe, fellow of the Institute, and also doubles as the chairman of the Governing Council Committee on Research for the Institute. Dr. Adedipe, you are most welcome.
Thank you so very much, Registrar CEO. And let me also, on this note, welcome the participants to this the advocacy dialogue of the Charist of Bankers of Nigeria, and also just gear you up for an exciting time with our keynote speaker and also the distinguished panelists that we do justice to the subject of conversation. So my next duty quickly is to introduce our President and Chairman of Council of the Charist of Bankers of Nigeria in the person of Mr. Bayo Olugbemi, FCIB, who, of course, shortly now will also address us, making some opening remarks that sets the ball rolling for this conversation we have today. And we have also three distinguished panelists that will do justice to what our keynote speaker is going to share with us. The keynote speaker is Mr. Kevin Amugo, who is the Director of Financial Policy and Regulation Directorate of the Central Bank of Nigeria. He is the architect and the owner of the policy. We will share his views, giving us the background to it, where we are today, and what we should expect in the near future with respect to the policy. And of course, we now have three panelists who carefully selected by the Institute to create a balance to the conversation. Now, on the one hand, we look at the operator represented today by the First Bank of Nigeria, whose CEO, MD, Dr. Adeshola Adedotan, is scheduled to be the one to give us the perspective of the operator to this policy, but ably represented by Mr. Segun Alebiosu, who is the Chief Risk Officer of FBN Holdings, and that is First Bank of Nigeria. So he also is one of our very good friends and professional colleagues in the industry for decades. So I'm sure he's going to send Dr. Adedotan excellently well. And also we have, from the perspective of the customers, those that will quote and unquote be impacted by the policy. And this is a very interesting dimension, because for me, as a member of this entity, this space, what that is that government and its agencies formulate policies, but the actual people that will implement those to be impacted, because it is the way they respond to the policy that we either make it a success or otherwise. So equally, the institute has carefully selected a representative of the organized private sector, and that is in the person of the national president of NASIMA, and that is Ajia Sawatu Aliyu, who today is ably represented by Mrs. Margaret Orakusi, who indeed in her own capacity as a major player in the maritime sector also have not only the perspective of the organized private sector, but even our own personal experience as a business person for decades in this very environment we operate in. And then thirdly, we are going to have the legal perspective going to be brought on by a senior advocate of Nigeria, Mr. Osaro Ehomame, who again is already with us, and that will give a real balance to it. So in which case, we have the agency, the policymaker, we have the operator whom this policy is going to help, and then we have also, on the other hand, the customers to be impacted, and then the one that would like to be an arbiter if there's any point of conflict among the various stakeholders to this policy. And let me also say this before I invite the president to give his opening remarks, that this has been long in coming, especially this is historical in a way, coming on in the year 2020, which was the year we had envisioned when we started looking at the credit market in Nigeria. I was privileged to be the team leader of the credit market when we were designing the financial sector strategy for year 2020, way back some 13, 14 years ago. And one of the major challenges we had then was the credit culture in Nigeria. And that is someone borrows from the bank and he believes that the loan is his own share of the national cake. So but what we are looking at today is a policy that can likely change that narrative. So based on this, I want to respectfully invite the President and Chairman of Council of the Chartered Institute of Bankers of Nigeria, Mr. Bayo Olubemi, to please give us his opening remarks. Thank you so very much, our guest here. Mr. President, sir.
Thank you so much, Mr. Dr. Biodun Adedipe. The keynote address speaker, Mr. Kevin Amungo, Director, Financial Policy and Regulation of Central Bank of Nigeria. The panelists, Dr. Adeshola Kazim Adeluton, FCIB, MD CEO of First Bank of Nigeria Limited and its subsidiaries, ably represented by Mr. Olusegun Alebiosu, Group Executive Chief Risk Officer, First Bank Nigeria Limited, Ajia Saratu Aliyu, National President of NASIMA, my National President, myself being on the council of the first and the foremost chamber movement in Nigeria, Lagos Chamber of Commerce and Industry, ably represented by Barrister Mrs. Margaret Nkem Onyema Orakusi, National Officer and Chairman, Maritime Trade Group, NASIMA, Mr. Osaro Egbobamen, SAN, Managing Partner, Paxton and Grace, our moderator, the arrowhead of BAA Consult, Dr. Abiodun Adedipe, FCIB, and of course, my registrar, Chief Executive, who is the host of today, Mr. Olusheye Awojobi, FCIB, Registrar, Chief Executive of the Chartered Institute of Bankers of Nigeria. It gives me great pleasure to welcome you, ladies and gentlemen, to this auspicious occasion when we are having the third in a series of our advocacy dialogue as an institute. Definitely, it is a very auspicious occasion, and we are happy that all of you are here this morning listening to us. From our record, since the beginning of the pandemic, the COVID-2019 or COVID-19, we've had 2 of these programs in a series, and this being the 3rd one. We are very happy to have all of you, and we believe that we will all stay glued to our system until the end of the program. And especially, we want to welcome all our participants, and we say thank you very much for coming. Ladies and gentlemen,
I think we're having connection issues there with the president. We just, while he is trying to reconnect, let me just quickly remind us participants to please keep all our mics muted. And then when we get to the time of question and answer session, kindly post your questions in the Q&A or chat box on the platform, or subsequently you can raise your hand, and we will attend to that between myself and my colleagues at the background coordinating the technical side of this dialogue. So please, while we hope to have the president back, I want us to please prepare with our minds and pay careful attention to what the keynote speaker will tell us. And of course, we take some presentations also for some few minutes from the panelists before we now come into our conversation, which will be triggered by their responses to what the keynote speaker says, and then a few questions that I will also raise with them. Thereafter, we come to the final session, which will be for the attendees to bring their questions forward. I think we are not getting the president to come back. Maybe if I have the permission of the registrar CE, we go ahead and take the keynote address. Will that be fine?
Very well, so that we move on. The president will come back, and then towards the end, we'll make it.
Hello.
Oh, okay.
Oh, the president is back.
I am so sorry. I had the technology issue here. I think am I being heard very well?
Very well, sir.
Okay, I can go on. I'm so sorry for that break in transmission. So sorry. I hope you heard some of what I said, or should I start from the beginning?
No, sir, you can just go ahead. We had you up to the point you wanted to give us some thoughts from your notes.
Ladies and gentlemen, it gives me great pleasure to welcome you to the 3rd edition of the CIBN Advocacy Dialogue Series webinar organized by the Chartered Institute of Bankers of Nigeria, CIBN Center for Financial Studies. The CIBN Advocacy Dialogue as a forum to and the economy in emissions on given subject matter. The regulators in ensuring the finances for banking and other businesses and enhance sustainable banking ESB model in the event of major economic and business disruption, tackled such critical issues which were documented in a communique and shared with all our various stakeholders, both the practitioners, the operators, the regulators, and of course the users of our services. The third installment in the series will be no different as we seek both to tackle a long-standing issue in the banking industry and to support the regulators in their quest to resolve this issue. Dr. Adidipe mentioned in his opening remark that we needed to curb what I call, if you like, call it excesses, or if you like it, call it the cake sharing mentality of the people that take our loans. I mean, over the years, when I was very young in the banking industry, you see a situation in Union Bank then, as it were, the passing circular all over Nigeria, all the branches in Nigeria, looking for a debtor. And that same debtor, just last weekend, he was in a party, spraying nairas and dollar. And after taking loan, some of them will go and marry a second wife, buy a car, and so on and so forth, not using the money specifically for what it was taken for. So this third series, with the theme non-performing loans and the global standing instruction GSI policy, impact and insights for financial stability, is very, very apt in view of its importance and relevance Nigerian financial system. I'm delighted to welcome our keynote speaker, AD, Director in the Central Bank of Nigeria. It's at times we are part of the whole system. So welcome, Mr. Kevin Amugo. He will share with us more details regarding the GSI policy and modalities for its implementation. We are also honored this morning to have in our midst our distinguished panelists, Dr. Adeshola Kazeem from CIBN, MD CEO, First Bank of Nigeria Limited and its subsidiaries, ably represented by Mr. Olusegun Alebioshu, Group Executive and the Chief Risk Officer of First Bank. We also have Ajia Saratu Aliyu, National President of NASIMA, ably represented by Mrs. Margaret Orakusi, the National Officer and also the Chairman of the Maritime subgroup of NASIMA. Thank you very much for representing our President. We also have Mr. Osaro Ehobamien, Senior Advocate of Nigeria, Managing Partner, Paxstone and Grace. We have bank customers, legal, and Grace. These experienced resource persons who address the subject from the industry operators, as led by First Bank, by bank customers, represented by NASIMA, and legal perspectives, being represented by Mr. Osaru Egbobiame. To moderate the session, we are honored to have a distinguished economist, banker, and our friend, not just a friend of the Institute, is my own personal friend and family friend, so to say, Dr. Biodun Adedipe, FCIB, Chairman, CIBN Research Committee, and Chief Consultant, BA Adedipe Consult. With this caliber of resource persons, we are sure to have a very robust conversation on this subject this morning. Esteemed audience, may I remark that the scourge of bad loans has no doubt been a long-standing menace to the Nigerian banking sector. The issuance of the GSI policy marks a new dawn in credit management and debt recovery process in our climb. Indeed, issues of non-performing loans, and particularly those emanating from the attitudes of unrepentant and serious debtors, will be more efficiently resolved as a result of this policy. Because a lot of these debtors, they move from one bank to another, like S-men, taking loan and leaving bad loan in its trade. Let me at this juncture state that CIBN is fully in support of the GSI policy, which will not only enhance loan recovery processes and financial system stability, but also promote economic prosperity. When borrowers pay their loans, funds are available to the financial institutions to service other customers. This way, we can promote shared prosperity and more people can be lifted out of poverty. This also has a nexus with goal number 8 of the United Nations SDGs, that is Sustainable Development Goals, which essentially advocates promotion of sustained, inclusive, and sustainable economic growth, food and productive employment, and decent work for all. Given the major significance of this policy, is the Institute's intent, that is CIBN intent, to educate our stakeholders universe, the banks, and its benefits and implications. NTA to talk said, when you know better, you do better. Distinguished guests, ladies and gentlemen, as expected and in line with the advocacy mandate of the Institute, and communique of this session will be circulated with a view to improving enlightenment forward to a very engaging, once again, to this event. And Registrar CEO, Doctor, you are on mute. Yeah.
Thank you, Mr. President. I think Dr. Adedipe is taking over right now. Thank you, sir.
Thank you so very much, President and Chairman of Council, Mr. Abayo Olugbemi, FCIB, for those opening remarks. They actually open our minds to some of the issues that we need to be considering today in this conversation. And also still in the spirit that the President said at the beginning, in order to manage our time effectively, I will now invite our keynote speaker, Mr. Kevin Amugo, who is the Director of Financial Policy and Regulation, Central Bank of Nigeria, is the process owner and the owner of this policy. There's no better person to tell us what it is all about and what the vision is concerning this policy and the future of the credit market and Nigerian economy. So, Mr. Amugo, please, you are welcome to address us this morning. Thank you so very much for being here.
Thank you, Mr. Moderator. Thank you, President, CEO, President, Chairman of Council, CIBN. Thank you, the Registrar CEO and panel of discussants. It's my pleasure to be here. If CIBN can load the presentation, we'll go right away. The outline, we have the outline there. I won't like to waste so much time because we're already struggling for time. I have to express my delight to the CIBN for inviting me to give this keynote address on non-performing loans and the GSI policy, impact and insights for financial system stability. I would first of all like to appreciate and congratulate the CIBN on the giant strides it continues to record, its dynamism and pursuit of professionalism in the banking industry, The advocacy series is another plus and commendable initiative of the CIBN, which we continue to appreciate. This is the third in the series. And in this particular series, we will seek to address critical issues affecting the banking industry and the economy, provide an opportunity to review recent developments in the banking system, look at its impact and contribution to financial system stability, with the team, why the team recognizes the importance of loan and advances as a major catalyst in the financial intermediation process of banks. And we also look at the measures the CBN has put in place to manage non-performing loans in the industry, because leaving it as it were, not taking appropriate actions on non-performing loans, we know that it has catastrophic implication on banking system stability. Go on to slide 5. Slide 5, yeah. Thank you. Go on, next slide. The CBN seeks to promote access to finance and responsible credit administration that have direct impacts on the incidence of non-performing loans. There seems to be a diametric opposite between seeking the desire to increase loans and advances and the incidence of NPL. Why it is the desire of every regulator that loans and advances increase in the system, because the increase in loan advances are the fulcrums, are the indicators of the performance of the aggregate economy. You need loans and advances to develop the economy. And for every loan or advance granted by a financial institution, there is the tendency that it creates non-performing loan. While the central bank wants loans and advances to increase, no central bank wants non-performing loan to increase. So they are always in conflict, or like it is a paradox. While on the one hand, I want loans to increase, on the other hand, I don't want loans, non-performing loans to increase. So there is this paradox. In checking this paradox, what does this regulator do? The regulator most times provide policies and regulations and framework with a view to curtailing the incidences of non-performing loans. And some of those things we have done over the years is the Code of Corporate Governance for Banks. And with the Financial Reporting Council, we are converting it to guidelines on corporate governance for banks and other financial institutions. This seeks to regulate, to moderate who manages these institutions, what are their mindsets, what particular attributes do they come, the board, the top management, their actions and inactions, are they self-serving, or are they in the interest of the philosophy and objective of the business and the aggregate economy? And again, we have the prudential guidelines. The prudential guidelines, for me, it is like a regulatory credit barometer. It measures the level of credits and the level of non-performing loans and advances, and how banks dutifully, religiously makes provision for non-performing loans and advances, so that at each time the integrity of the banking system is enhanced, the integrity of the loan book is enhanced, the integrity of the overall economy is enhanced. Then we have we also issue guidelines and regulate licensing of private credit bureaus. What the credit bureaus do is that they provide records and credit score for each borrower in the system. What this helps is that it helps the banks in granting loans to individuals to make the right call as to the integrity of the loan beneficiaries. This person I want to extend credit to, can he pay his loan, even though he has the money, even though he has the collateral, even though does he have the capacity to pay when the loan is due? And these are the kind of calls, these are the kind of reports, and these are the kind of credit scores credit bureau give to individuals. The enable banks make appropriate calls in extending loans and advances to such individuals. Then we have the, of course, the redesigned credit risk management system. This is the industry credit bureau that for every bank that grants loans and advances to a particular obligor is supposed to record such, is supposed to upload such records in the credit bureau, and periodically continues to update such records to show the performance status of that obligation. When the obligor is not performing, the bank is expected to so indicate, so that another institution that wants to extend similar facility to such an individual will be properly guided as to the kind of person he wants to enter into loan negotiation and loan arrangement with. So it is like also it navigates the credit administration in the system. The COVID-19 related intervention funds, like I said earlier, every central bank wants to credit not to continue to grow. But with the incidence of COVID-19 pandemic, it was obvious that it was going to impede and impact credit growth. And CBN, being a very responsible institution, had to create avenues to ensure that the banking industry, the Nigerian economy, is properly serviced with appropriate credits, especially to the household and SMEs that will be mainly affected by the COVID pandemic, to create facilities for them to create opportunity for them to access facilities. And like I said, creating a facility also has a problem with the issue of NPL, because for every facility created, the tendency, the possibility that there will be non-performing loans are high. And that is why in the regulatory measures also, we have asked banks to look at their customers, look at the impact the COVID-19 pandemic is going to have on their businesses, and put in place proper structures to restructure such facilities in order not to begin to balloon non-performing loans, because we know the effect of non-performing loans on the banking system and the economy as a whole. And that is why we created the intervention fund. We also moved ahead to ask banks and other financial institutions to create opportunity to restructure loans that will be adversely impacted by the COVID-19 pandemic. And of course, I'll talk about the Global Standing Instruction later. The Global Standing Instruction seeks to achieve three objectives: to reduce the rate of unserviced loans, to improve loan recovery efforts, and promote responsible borrowing in the banking industry. That is, in essence, what the GSI seeks to do. And as we move ahead, we'll maybe interrogate and underline the philosophy of the GSI. If you look at the non-performing loan trend in the banking industry over a 10-year time horizon from December 2010 to December 2019, you see that the non-performing loan trend is like a frequency cycle. No regulator likes the non-performing loan cycle trend to be like this. Every regulator look at the trend between 2011 and 2014. That is how in a responsible environment, that is how the NPL line should be. But look at this, it is like a frequency cycle. But what is very obvious here is that the NPL here is a reflection of the developments in the aggregate Nigerian economy. You will see that before 2010, the issue of the global financial crisis, it had catastrophic effect on the economy and on the banking system that caused NPL to balloon. And the CBN had to intervene. The intervention of CBN in 2010-2011 through the risk management efforts we did at the creation of AMCON brought a sharp reduction in the value of NPL to about 5% in 2011. And the gradual slide reduction continued up in 2014. And by 2015, it has started rising again. And this 2015 also reflected the period in our Nigerian economy where we had commodity prices, crash in commodity prices. Oil price decreased from almost $100 per barrel to about $20 per barrel. And you see that how it reflected on the NPL, and which means that as the NPL is increasing, what is obvious is that the financial stability is being threatened, and the economy, the aggregate economy, is also at risk. By 2017, of course, the CBN, being a responsible institution, will not allow this. Also introduce a number of policies, a number of regulatory policies that substantially brought down the NPL to about 6% by end of 2019 through taking out some outlier bank, taking out, allowing a major bank to sell its non-performing loan to private asset managers, and this substantially also reduced the NPL. And you see that by 2019, 2020, you will see that we are almost reaching a turning point. The curve has started inching, and that is where the GSI policy has come in to enable the CBN nip in the bud the incidence of NPL having a turning point at this point to begin to rise up again. So that with other policies, the issue of restructuring, the issue of NPL is like they have come at the appropriate time. And the incident, and one other thing that is instructive of this NPL curve is that it also shows the curve of crisis in the banking system, because at each point, as the NPL is rising, the instability in the banking system is rising, and as it's coming, the banking system is becoming stable and becoming proper situated to play its financial intermediation roles. So, looking at the GSI, change, please. So, the GSI is only mirroring what we have, the set of clauses we have in banks' loan documentation records. In bank loan documentation records, it allows a bank to, in the event of a loan default, to aggregate all the accounts of the customer to be able to set off the debt of a defaulting customer. So if I'm a borrower in Bank A and maintains other accounts in the same bank A, if my loan account goes into default with the set of clause, the bank is at liberty to assess my all other accounts that are not loan accounts, pulls resources from them and set off the loan account. So what the GSI policy is that the GSI policy is mirroring this arrangement the banks have for its individual accounts to extend it to the banking industry. What it means is that if my loan account in Bank A goes bad and I have account in Bank ABC, with the GSI policy and with my prior sign off to this arrangement as an individual, the bank can access my account in Bank B and Bank C to be able to make good my loan account in Bank A. That is just the protocol the GSI policy is doing. And how does it work? It identifies the borrower's account in other banks. It identifies the borrower's account in other banks. It determines cash balances in the individual identified eligible accounts, aggregate them based on the outstanding amount. The GSI triggers a debit in all those accounts to make good the defaulting account. But in doing that, we provide safeguards so that the operators are not reckless, and it doesn't give room to recklessness on the part of the operators, and so that at the end of the day, there's integrity in the system. What it does is that we have at least established a threshold. One, the effective date for the GSI, of course, we convert to a circular, is August 1st, 2020. And the mandate to debit must come from the must be executed by the borrowing bank. What it does is that from August 2019, as part of our agreement, we issued a circular so that every loan, every loan obligor is required to sign a GSI mandate that authorizes the bank to access its account in other banks to make good its loan obligation if it defaults in that respect. And we say that the GSI protocol originates from the lending bank. So it is not any bank is not at liberty to trigger. It is only the bank that has lent out money and that is at liberty to issue the trigger. And before a trigger must be issued, there are prerequisites. One is that loan, if a loan is granted to a customer, the loan must be reported to the CRMS. So the CRMS is like the base record. And like I said earlier, as based on the performance of that particular facility, it should be so reported. If it is performing, you cannot trigger on a performing account. So in the CRMS, you must have indicated account as bad. Bad means that it is not performing. It is when an account is bad that you can trigger. And before you can trigger, there must be a minimum stay in the creation in the CRMS of 90 days, which means that the account must have existed in the CRMS for a minimum of 90 days. And the account would have followed the traditional prudential guideline classification before you can be classified as bad and before you can originate a trigger. And to also discourage excesses, banks are not at liberty to just trigger anyhow. Just you create an account is just performing and fairly. No, trigger. No, it is not so. And the amount you must trigger you must not include a penal charge. So it is only the loan amount plus accrued interest that is allowed to be triggered. So if there is any penal charge, you're not supposed to trigger on a penal charge. And in assessing accounts in other banks, there are accounts we recognize as post-note debit due to maybe a court order, security service order, probate, fraud or lien. When such accounts, they are indicated as post-note debit accounts, and even though there may be fund in such in an account with such classifications in other banks, the GSI protocol precludes these accounts from being triggered. And where an institution intentionally shields an account from being triggered, under the GSI guideline, the institution will be properly sanctioned, and where the institution also negligently triggers an account that ought not to be triggered, there are also sanction regime for that. If you look at the performance of the GSI between August 1 and August 9th, there are over 26,000 triggers with cumulative value of 1.66 billion. But recovery to date within that period was 50 million. What this tells us is that even though there is a GSI that allows us to trigger, there is no 100% certainty that what is triggered must be recovered. But the good thing about it, the flip side of it is that there is no hiding place again for the predatory borrower. Wherever your account is, as long as you have account in the banking system, it's open to be assessed if you default in honoring your loan obligation with a particular bank. These accounts, these recoveries today may appear small. It is not small because where the bulk where the bulk of the recoveries will be made will be in the corporate accounts. What we have done is just the first tranche of the GSI mandate, which is individuals. Now, from the next step, you can see that we are working on GSI for non-individuals, for corporates and big organizations, and we'll soon release the operational guidelines. By the time this comes into effect, I know that the level of recoveries will be quite huge. And we also have a number of individual SMEs with the other financial institutions. And we are working on that. And the first thing, like I said, is onboarding them on the CRMS platform before they can enjoy the GSI privileges. we are working with the other financial institutions, the microfinance bank, primary mortgage banks, finance companies, etc. By the time we finish and onboard them in the CRMS, then we also graduate them into the GSI platform. And at the end of the day, to ensure that the whole financial system architecture is covered, we also look at the money, mobile money operators, so that at the end of the day, all accounts that ought to be assessed are assessed. By my conclusion, I will know that banks play a key role in financing developmental projects and facilitating economic growth in the economy. And a stable financial system, to a very large extent, supports banks in carrying out these roles. Therefore, the appropriate regulatory policies are needed towards ensuring a safe, sound, and stable financial system. And what is obvious is that financial stability is not in the interest of only the regulators. Every stakeholders in the banking ecosystem benefits from financial stability. Both the aggregate economy, the operators, the regulators, and all stakeholders are beneficiaries in a stable financial environment. The central bank, in collaboration with the operators and stakeholders, will continue to play the prominent roles that are expected of it in ensuring that the integrity of the financial system is strengthened. I thank you for your attention.
Thank you so very much, Mr. Amugo. And that was quite so very deep thought on the subject matter. And I believe also the attendees have paid very careful attention. And just to highlight the fact that, yes, the view of the central bank as the apex regulator in the banking system is to see loans increase in order to drive economic activities. But at the same time, we recognize that, yes, non-performing loans might be inevitable, but there are rules and regulations to set that within limits that are healthy, not only for the banking system, but for the overall economy. And that is what the focus of the regulator always is on. And also, he mentioned that GSI had existed before, but of course, within the context of each individual bank. So what the policy now has done is to escalate that such that it is now industry-wide. And of course, there are also preconditions for any customer's account to become subject to this. And he mentioned in particular that, number one, the account must have existed for a minimum of 90 days in the CRMS. And of course, we know quite well that ultimately, we all desire a stable financial system. On the one hand, there's safety, soundness, and stability of that system is beneficial to all the stakeholders. That is the regulators, the operators, the customers of the banks, and of course, every other stakeholder within the banking and finance and economic space in Nigeria, and in fact, also globally. I've seen a few questions in the Q&A chat, and of course, the Q&A box, as well as the chat box. Please, attendees, keep posting your questions there. We'll attend to them subsequently. So, having had that keynote address, we now move to our distinguished panelists. And let me say a very big thank you to Mr. Kevin Amugo for putting us in proper perspective on this policy. So I will go by the order we have the names on our agenda. So I will invite Mr. Segun Alebioshu, who is representing Dr. Adenutan, to please address this dialogue on the operator's perspective to this policy. But because of our time, I may have to take away 3 minutes from each of the panelists now, because you still will deal with the rest of this dialogue session anyway. So we expect you to speak for 7 minutes instead of 10. And I believe with the help of God, let me put it that way, we'll be able to keep to that time limit. So Segun, please, you have the floor. Unmute your mic and talk to us. 7 minutes.
Okay. Thank you, moderator. Thank you, the presenter and the Council of Fraternity of Bankers of Nigeria. GSI is what we have all been looking forward to as a coordinated approach to addressing the NPL issue in the industry. You agree with me that bank failure is not ordained. It's just the behavior of what we have in our environment. I mean, we saw a time in this country that we have over 80 banks. We have a lot of failed banks. During the late General Abacha, there was failed bank tribunal. Bad loans everywhere. It got to a level, my own younger brother told me that you need to borrow money from a bank and default to be rich. So it tells you what the culture is talking about. I had to run away from him. So if he has gotten to a level that even the ordinary man on the street believes that he must borrow money from a bank and not pay back, and that's why he will reach, then something is really wrong. And we need to address it. And so the culture, which was mentioned before, or you said when you were presenting, it's a very big issue, the credit culture, the trust environment. And I'm bringing again, I just believe that you can chat for you. I mean, you can get things around you. And then you have to be struggling from outside. The legal environment is also tough. You go to court, you are there for 6-7 years. On your right, if the guy takes your money, you are out. It is you that will be running on the other side. You see, even when you get to law enforcement agents, it's a different thing entirely. You'll be paying to get justice. In what, I mean, so how do you grow an economy in that situation? I always hear that the top 300 names in banks gets the 70% of loans. 70% of loans in banks are to top 300 names. Because banks are afraid of the other guy who has not been tested, who has defaulted before, who's going to cause them havoc. And this is one of the biggest problems of lending to SMEs and consumers. In advanced world, SMEs, they grow because banks can trust them. Because discipline has been brought to the process. Consumer loans are everywhere. You can imagine in Nigeria, we're all struggling for consumer loan. We're all struggling with SME. You're afraid of the next person because you don't even know. Once the guy takes the money, the guy is out. You have to start running after him. Even the cost of recovery will be more than the loan you have given if you are not careful. And that's the environment we run. So how do you want to grow? You saw what happened to Amcon? Of course, Amcon came to rescue the industry. 10 years after, from the report we are seeing, Amcon is still there with over 2 trillion bad loan, no yet recovered. So you can ask yourself, if Amcon cannot recover in 10 years, over 2 trillion, a government agency with government power, with government authority, with all kinds of support, over 2 trillion still outstanding unpaid, you can imagine what will happen to private banks, the way you have to struggle. And that's the environment. And these loans were to Nigerians or to Nigerian business people. And from what my mom used to tell me, that money does not disappear. You must have used it for something. You can't tell me you use 1 billion to eat. You can't tell me that you use 1 billion to buy car. That money must have been somewhere. It's either you have hidden it somewhere or you bought something with it and you don't want to give it back to me. It doesn't disappear. So how is it? So it's important that GSI will deliver. And as presented, I mean, we started 50 million recovered. Excellent. I'm sure after 1 year, the number of recoveries will increase. I'm also sure that by the time with 3 years, when we started refining the entire process, SMEs and corporates coming in, you will see the number will go up and there'll be discipline. And one thing is this, if you check when credit bureau came to Nigeria for the first time, people knowing fully well that credit bureau will throw you up, people became conscious and started trying to work on their credit rating. Okay? These days, some people will say, I will borrow sufficiently that I won't have to go back to borrow again in another bank. So they will steal you dead. So credit bureau, no credit bureau. But if GSI is there in addition to credit bureau, you will know that wherever you keep the money, we will find you. And you can't keep 1 billion under your bed. Otherwise, I'm the ones who come and visit you. So you must keep it in the bank. We will look for you. And that we think will bring about sanity. Thank you very much.
Thank you so very much, Shegu. That was quite incisive from the operator's perspective. The major take we pull out from there, I would say, 4 important things. One is that this is a coordinated approach to non-performing loans in the Nigerian banking system, of course, alluding to the fact that bank failures historically, and this in fact is not even peculiar to Nigeria, as most of the time, maybe 90–95% of the time, been traced to bad loans. And of course, also the fear that banks have in lending to MSMEs and consumers, which in fact is the particular sector and segment of the credit market that can bring the growth and development that we desire. And of course, the fact of, at times, cost of recovery can be much greater than the amount you are actually pursuing to recover. And the good news, which of course was in Mr. Amungo's presentation, is the fact that within the space of just 9 days, 50.3 million naira have been recovered using this instrument of GSI. So which of course tells us that it's a very positive one with high prospects. So on that note, we move on now to the one that the policy will impact, and that is the bank borrower. And of course, we have with us, as I earlier introduced her, the pleasure of Mrs. ADVOCACY, who of course, in her own standing, is not only in NACIMA, but also a major driver of the maritime leg. So you again have 10 minutes, madam, to address us from the perspective of the borrower or an operator that is affected by this policy. So what is your perspective to it? Please unmute your mic. Yes, 7 minutes.
Yeah, thank you very much. We at NACIMA, we are glad to participate in this edition. And we thank the organizers, CBI, for what they are doing. NACIMA commends the CBN for the GSI, being aimed at facilitating an improved credit repayment culture, thereby reducing non-performing loans in the Nigerian banking system, as well as to watch list consistent loans. Of this country has really suffered. When we remember the former initiatives of granting loans to establishment for like the National Shipping Line, which people saw as a free-for-all cake. It is rather unfortunate to note that there has not been effective monitoring of non-performing loans and sanctions against defaulters. Lessons must be learned from this to prevent future surge in the rates of non-performing loans. As the voice of Nigerian businesses, NACIMA is of the opinion that the GSI policy has the capacity to promote a stable financial system and enhance loan recovery across the Nigerian banking sector if properly implemented. While NACIMA applauds the objectives of the GSI policy, it is very crucial to point out that one of the major reasons for loan defaulting in Nigeria is unfavorable terms of payments. For instance, the high interest rates. It has to be competitive, and it has to be, if possible, on single digits. NACIMA hereby advocates for a reduction in interest rates, particularly during an unprecedented time such as this, with the effect of COVID-19 pandemic globally. There have been reactions and opinions from bank customers on this policy. Some of these opinions are hereby highlighted. The GSI policy indirectly improves customers' credit ratings, as the policy will compel prompt repayments of loans, which in turn boosts their credit rating and history. The GSI policy would eliminate incessant harassment by bank collections / loan recovery agents, as the policy affords creditor banks the opportunity to recover past due obligations without recourse to the borrower. It also will help increase in access to finance for credible borrowers if implemented effectively. The objective of the GSI policy to reduce non-performing loans may not be achieved, as the policy is only applicable to personal accounts, given that majority of bad debts in Nigeria, according to reports, are corporate loans rather than individual loans, even though it is a step in the right direction. There is a general concern on approach to compensation for customers wrongly debited due to a GSI activation. The guidelines provided by the CBN does not clearly state a compensation mechanism for such situation. We recommend as follows: 1, increased nationwide sensitization by the CBN and creditor banks on the GSI policy and its implications for bank customers. Some of these bank customers dwell in the rural area and their level of literacy is quite low. So there must be an effort to reach everybody with this information. Adequate monitoring of creditor banks by the CBN to ensure that the implementation of the GSI policy truly results in increased access to finance for bank customers. Re-establishment of clear compensation mechanism for bank customers in the case of wrongful debits due to GSI activation. Thank you for your attention.
Ms. Oraguzi, that was quite straightforward and pointy again. As I said earlier, I'm not going to do any recap of that. They very clearly said that NACIMA support the policy is commendable, and of course it will achieve the objective as earlier stated by the Director of Financial Policy. And of course, as a passing reference also, that perhaps what also enhances this problem that we are trying to resolve with the policy is the fact that the terms of lending by banks are favorable to the borrowing customer. Then the reactions of the customers were also captured here, that it's positive with respect to credit rating, eliminating seller harassment, and of course, improving access to finance, then extending also should extend to corporate loans as well, and the issue of redress, which is about compensation for wrong debits. Of course, mentioned there what the CBN should take away from this and the operators as well, and that's sensitization by the central bank and the banks, and of course, monitoring of the participating financial institutions by the central bank, and again, reference to the issue of redress. So let me now call on the legal luminary who will now give us the legal perspective. So our very good friend of the Institute, Mr. Osaro Eobame, please unmute your mic, 7 minutes. Thank you so much. Please unmute your mic.
Can you hear me now?
Can hear you.
Oh,
yes,
great.
yes, please.
Great.
Yes, please.
Thank you very much. Let me go straight to the issue, Doctor, because I know we're struggling with time. So from the legal perspective, the first point to make is that this transaction or the global standing instruction is based on a consensual agreement. In other words, all the parties have agreed that this will work. So the customer is required to give his mandates, as he's applying for a credit. I had seen a question asking whether this is retrospective, whether you could apply it to defaults that had existed before the 1st of August. No, by the very nature of the entire scheme, you are required, the customer is required to give his mandate. And I think that is a good thing, because when we're talking about set off, it is just simply a reconciliation. And I think it was Mr. Mogu who made the point that before now you had principles of set off, but within the same bank. In other words, you could simply set up the credit balance against the debit balance in the same bank. Usually, before you take the loan, in the agreement, you have the principle of setup. But even if you don't have the principle of setup, the courts, the advanced courts have said, where you're indebted to a bank and you apply, because an indebtedness to the bank simply means that you owe the bank. And then if the bank in turn owes you because you have an account that is in a credit balance, when you make an application to the bank to withdraw money, the bank will refuse to discharge that obligation on account that you are indebted to it, and therefore will refuse to reduce the credit accordingly. So it is just a reconciliation within the banks, and it is better to have an agreement. What the GSI has done is to escalate that agreement. So you have banks without borders. So it's almost like you have one single bank and you're permitting for reconciliation, which is fantastic. So I don't think there's any issue about legality, because I know people have argued whether or not you're interfering with property. I hope I'll be able to deal with that during the course of the question and answer session. The second point I'd like to make is this question of the last resort. In other words, you cannot trigger a GSI until you can trigger it only as a last resort. The question is, what is the meaning of the last resort? Again, I think Mr. Amogo provided some insights. Is going to the methodology of determining that is by the prudential guidelines. And I think if the loan is substandard, in other words, 90 days, you could apply the trigger. Although, of course, issues could arise now, because once you have a 90 days window, the recalcitrant borrower may withdraw monies in other accounts, but it can only do that for now. Once you bring in all the other financial institutions, it becomes almost impossible to hide, if you see what I mean. You cannot move away completely from the financial sector. The other point I'd like to make on this question of last resort is whether you need to exhaust the collateral that has been provided by the borrower before you can trigger. The collateral is a secondary method of repayment. It is not the primary method. We lawyers take it that when you're talking about recovery, you're talking about the loan itself. It is true that you can proceed to the collateral, but I would imagine that the definition of a last resort is that you cannot pay, not that the bank is required to pursue the collateral before you proceed that way. That is the sort of interpretation that I would give it. But it would be good for the guidelines to clarify this. The other point is the education. I see in the guidelines that you have a provision that says that the customer should be educated on the consequence of giving his mandate. And I think that's a good thing. But I think there should be included in that proviso a caveat that he will also be required to rely on his own judgment, because you don't want a situation where a customer says, well, I didn't understand the consequences and therefore you cannot set off my credit against the debits. So I think it's important that we just clarify that. The other point is on the accounts that are constrained and restricted. In other words, you cannot apply a GSA. I think it's important to include a reserve savings account. In other words, the pensions account. Generally, the pensions account is excluded from judgments and things like that. You don't want a situation where a debtor's pensions account is depleted, because the pensions account, of course, is for the future and, you know, to keep him when things are, when he's unable to work anymore. I'd make also a point on the dispute resolution. There will be disputes, and let me explain what I mean, especially when you escalate to the companies. The method of priority is always an issue. In other words, where two banks are looking to a third bank who has credits and both has given a loan, who takes priority to debit that credit in favor of the debits? There are three scenarios that I can think of. The question is it the bank who first activated the GSI, or is it the bank that has satisfied the prudential guidelines, or one that has given notice first? I think there should be some clarity on this. There's a provision that talks of debit priority, but I don't think it is sufficiently clear. Now, when you have those sort of issues, you're going to have some disputes. If you look at the acts, it talks about arbitration. So it's implicit, perhaps, or the guidelines, is implicit that it is the arbitration that will be used to settle disputes. But I think there needs to be clarity, and the arbitration must be very thin. It shouldn't be elaborate. So we have introduced a similar arbitration in the mortgage provisions, where the NMRC has come to provide secondary financing for primary mortgage institution. And I think we can introduce a very simple one-man arbitrator, something like that, the bankers committee, rather than taking it to court. You don't want a situation where all this is bogged down in court. Now, I know a few people will jump at me and say, oh, you must, you know, the court says constitutional. But what we do with these things is we say it's a precondition, and you are signing an agreement to allow it to be resolved in a very simple way before you go to court. So even when you go to court, the court will say to you, go back, resolve this in the most simplest way before you escalate it. There is obviously the question as to this 90 days notice, because you have situations where a recalcitrant borrower might dissipate his assets before you arrive, before you are able to attach those assets. Now, if that happens, we have a principle of law that allows you to attach property even before you get a judgment. It's called the Mariva injunction. I think we need to introduce that into the scheme. Finally, and I'm just talking about points, is the question of bankruptcy. You see, the bankruptcy laws are very weak, and therefore you don't see us using it. But if you look at the statute books, it provides a remedy for creditors. Because if a person is made a bankrupt, it means he cannot, of course, obtain further credit. He cannot, especially, he cannot contest elections to go to the House of Assembly. This is key, because with the greatest respect, you find a lot of politicians might be indebted and there's nothing you can do about it. Because the bankruptcy law is a secondary system. That's what we're operating here. You need to first go and get a judgment before you can make someone bankrupt. It's a secondary application. That is a big default. The company law has just been amended. I don't think that provision was attended to, unfortunately. It's something I think the central bank should pursue, especially when you're dealing with consumer loans, consumer credits. Without a bankruptcy law, it's almost like there's no sanction. Once you've taken a loan and you are within the financial system and you're using the system and you're abusing it, then you should be declared bankrupt, and all the consequences of a bankruptcy should follow. Of course, I know that we're going to be escalating to the companies, which would be very good, so that you can make many more companies insolvent. Let me stop there, because I think it will be more interesting when we're having the interaction. Thank you very much.
Thank you very much, Mr. Eobabe. And that was quite incisive. Quite a lot of issues raised there, and they're also expanding the conversation. And that is to underscore the fact that this policy is consensual. That means both parties to the matter at hand must agree to be on the table and also to work this out. And of course, the dimension you also mentioned, which makes it even more interesting, is that we are looking at the banking system now where we have banks without borders. And of course, to clarify the fact that GSI is a last resort, which brings into the conversation the issue of collateral. And of course, in talking about the fact that the basic consideration by banks is the source of repayment, and that is the cash generated by the borrower with which he or she repays the loan. Now, if that fails, then you talk about the fallback, which is collateral, as Mr. Obama mentioned, before we now talk about triggering the GSI. And of course, he also brought a very important dimension which will enhance the policy, and that the fact that it should be made clear to the customer that it is his judgment that is at stake here, so that the customer doesn't give the impression that he was misinformed or didn't understand what the policy meant when he was signing the document. And of course, the fact that pensions accounts, that the PSAs should be also listed among accounts excluded. Then the issue of arbitration, which was also mentioned, although he said arbitration should be thin, and that should be in terms of settling disputes that arise from the process. Now, of course, a number of other things he said, but again, I'm acutely conscious of our time so that we get more from our panelists. Now, I will take the next maybe 5-7 minutes to pose particular questions to each of the panelists, and then also take some. I've already visited the Q&A box as well as the chat box, and also already extracting some questions from there. So let me start with Mr. Adebiosu. And this is a perspective that we got from several conversations about this policy, that in light of the fact that banks will have access to all accounts in Nigeria owned by a debtor, what effect can this policy have on the general willingness of bank customers to deposit their money in the banks? That is to say, if customers begin to look at this as, if I deposit my money with banks, it means in the event of default on the loan and the GSI is triggered, that means the bank will establish lien and of course take my money. So can that discourage customers from depositing money with the banks? So Mr. Adebiosu.
Thank you. Good question. We talked about this ourselves, and we said you can keep 10,000 naira under your desk, under your bed. You can't keep 400 million, 300 million under your bed. There's no way to keep it. I mean, you must keep it in the bank. Otherwise, you will lose it. Aside from me, the bank not getting it, you yourself will lose the money. So it is your own interest to bring the money into the system. Again, this will force conversation. Because if you are owing me, you are discussing with me to show your loan, you pay me out, I'm not likely to trigger GSI. As Mr. Amigo said, it must have been bad, must have been CRMS for 90 days. I mean, that means that dialogue has failed, account has been classified, you are not coming to discuss, we're trying to reach you, you are not cooperating. So things must have broken down before we say, I'm going this way. So we give you leeway. So you don't have a choice. I mean, you can try, but I'm sure Amrabas will visit you more than the bank will do. So the choice for you to put the money in the bank and let us discuss.
All right. Thank you so very much for that. Let me come to Ms. Orakusi now from the perspective of the borrower. Now, let's assume that I'm already existing on the loan book of a bank as a borrower. And now I'm aware of this GSI policy which is being implemented. So what can I do to prevent my business getting into a position of bad debt that will cause my bankers to trigger the GSI? What should I begin to consider in the way I run my business? This is Orakusi, please.
I think the thing to do is to make sure that whatever you are going for is viable. And it will also, you have it that I am borrowing. this is not my money. And the intention to repay must be there. A situation where you think that the loan is your own national cake or meant to hire more wives or whatever, it's not good because our economy is not growing. It's when you borrow and you return, then the next person borrows and development takes effect. The only thing that would kill a serious-minded business person from borrowing is the rate of interest. And that's what we are saying. Our economy cannot all the time be in a peace atmosphere. We should compete with what obtains in the international market. How much is the cost of fund? We are competing with people who borrow on probably 2%. And that discourages a number of people. You borrow money from the bank, maybe you have borrowed 10 million, and in 2 years, the 10 million you are paying back forever. You pay back almost double how much you borrowed. So in order to encourage people not to default, interest rate
I think we are having a connection issue there again. Well, that is what is happening all over the world, the new normal, and we have to bear with that until capacity expands. I think on the issue of the cost of borrowing, interest rate that Ms. Oragosi mentioned, maybe later in this conversation, I want Mr. Legbo to address that so that for the customers on this platform, they can also understand why borrowed funds are expensive in our client. But let me come to our legal luminary, Mr. Ebawe. Please, there is a particular issue here that someone had raised in conversation about this policy. That Section 44 of the Nigerian Constitution provides that no law shall allow for the compulsory acquisition of any property without allowing the property owner the right to access a court or tribunal for the determination of his rights. Is there any interpretation here of whether the GSI policy actually runs contrary to this provision in the Nigerian Constitution? Please, we need clarification of that.
Thank you very much. Before I answer that question, I'd like to make a reference to the first question you asked, which is, will people withdraw their money from the banks as a result of this policy? Now, if we wanted to be serious and make this effective, you normally will work with the law enforcement agencies. Now, if you spend cash over a certain amount, it doesn't mean you're necessarily a criminal, but the burden rests on you on while you're spending cash outside the financial legal system. So all the time you are required to explain. So there's a Money Laundering Act issue by spending cash of a certain amount, which is very, very penetrating in terms of how it affects people's individual lives. Normally, what happens in other countries is that, let's say you were caught in a crime, or you had been doing anything, or you bought assets, or you're living beyond your means. Even in our EFCC Act, you have that. They have a right to investigate your livelihood. Now, what will now begin to happen is you investigate the banks as well. And if a man is indebted, it means there's a deliberate attempt to now circumvent payments. Under those circumstances, you are almost moving to theft. So I'm going to say that for this to work, you need collaborations with the agency, just like the tax office. If you do something else, people can investigate to see whether you've paid tax. I just wanted to make that point. Now, to your other question, whether it breaches the property law. Of course not. And I think, unfortunately, it's a gross misunderstanding of how financial assets work. When you have a credit in a bank, all that it means is that the bank is indebted to you. So by an instrument, you can ask that bank to pay you. It is what we call in law a shows in action. What the GSI does is to discharge that bank from its obligation to pay you. That's all it does. It's simply saying, we're going to set off your credit balance against a separate debt owed to another bank. It has nothing to do with, in fact, the property is not yours. We say money is fungible. Money is fungible because when you give it to the bank, it becomes the bank's property. The bank is only indebted to you every time you issue an instrument in accordance with the contracts. So the question of Section 40 doesn't even apply. And beyond that, remember I started by saying there's a consensual agreement anyway, even if you don't agree with my conceptual philosophy about how property works. But financial assets that are kept in a bank, we have to understand it. And this, we need to educate the judges with the greatest respect, because sometimes there's always a misunderstanding on how financial assets work. Financial assets are property, but they are abstract property. In other words, if I give you money, you're not required to give me that money. You're only indebted to me. So you become a debtor to me. So Section 40 is inapplicable. That's the simple answer. Sir.
Thank you so very much for that. Let me now give Shegun maybe a minute or two to talk to this issue of the rate of interest that Ms. Oragusi has raised maybe 2 or 3 times now since we started this conversation, so that we can all understand where it's coming from. So
yes, excellent. The Nigerian populace seems not to appreciate this issue of interest rates, and that banks are actually helpless. Now, there's something called cash reserve requirements. So for any deposit you give to a bank, a proportion of that will be held with central bank as cash reserve. Statutorily, CBN moved it this year to 27.5, which means that if you give me 1 million naira deposit today, 275,000 out of the 1 million, CBN will keep it with themselves at 0. But I will pay you interest on it as a depositor in full. You don't want to hear. Okay? Averagely, what we have seen this year is that average cash reserve requirements across banks over 40%, which means that over 40% of deposits that we have in banks are any 0. And banks are paying interest to depositors on them. In addition, we will pay 1% NDIC premium. We will pay 0.5% AMCON premium. By the time you add that to the cost, so if I give you a deposit at 5%, for example, 40% of that is out. So if I adjust rates by 40%, it means that effectively that deposit you give to me at 7, because I'm going to pay you on 100%, but I'm getting benefit for only 60. So if I adjust it for it, then my cost is 7. By the time I put NDIC premium 1% and I put AMCON on it, and we're already talking about almost 9%. On the deposit you thought you gave to me, 5. I've not put overhead. By the time I put overhead, in the country where I have to run diesel everywhere in all my branches, all branches of First Bank has 2 diesel generators. All. Because you cannot say you are counting money, I want generator spoil, and then the second one cannot take off. You cannot afford that. Okay? So we have 2 generators in every branch. You must fuel them. There's no electricity, yet the ATM must work, which means that I must power the inverter batteries of ATMs. I must have batteries for them. I must replace them. Insecurity is everywhere. I have an average of about 3 or 4 mopoles in every branch. You have man-truck. You have all kinds of things that you have to put in place just to ensure that you secure your branch. So all these things come into the cost of funds before I can say I'm lending. So by the time I lend, it's a serious thing. Today, rates came down materially, interest costs came down, everything came down. People are borrowing in the industry. But we also remember it was the same time, I remember in 2009, 2008, 2007, people were borrowing money at 12, 14 in the market. Yet, people defaulted a lot. They took so much loan. So I always tell everybody that yes, interest rate matters, but we must understand the environment. Now, even with the environment itself, when inflation is about 13%, okay? If inflation is about 13%, of course, it tells you what the operating environment should be. So if your lending rate is below inflation, it tells you something about it, okay? So if your investment rate, because the person that's going to give deposit also will have to give deposit at lower than inflation rate, right? So the person who can decide to say, I will give deposit to these banks. Let me go and buy land and build the houses and sell. I will make more money than inflation. Let me go and buy biscuits. That's why trading makes too much money. Because people that trade, they can ride the inflation curve and make money. And that's how too many traders all over the place, because you know the implication. Of course, in the last 4 or 5 years, CBN came out with a lot of structures, a lot of funding schemes to support real sector. And all these funds are single digit. All. The 1 trillion manufacturers loan and real sector loan, the 50 billion SME, all kind of schemes, the RISE scheme, the partner aggregation scheme, everything. They're all single digit. In fact, the RISE scheme, the partner aggregation scheme is about 5% or 3%. So it's so easy for people to get those things, but banks will have to support, because banks will have to give guarantee and support to CBN. Like, if you default, I'll pay. Which means that if you have behaved well, if you are not a defaulter, if you have done business with me well, I can give my grant to CBN on your behalf, and you can get single digit loan, which will come to me, and your business will flourish. So cheap money is everywhere in Nigeria for whoever wants to do business. But the question here is that which bank will trust you? The bank that you have not paid their loans, the one you defaulted the last 4 or 5 years until it was written off, and you are boasting that they won't collect any money from you. Which other bank? I mean, how would I take that kind of risk on your behalf? But if the economy is to move ahead, the trust environment must be fixed. And that's one of the reasons why DSI is going to force the conversation. And as the legal Leonard Senior said, the bankruptcy law needs to be brought up. It has to be punitive. And we need to have economic court. We can't just be going and be pleading fundamental human rights somewhere when my loan is outstanding. I'm asking you to pay me, you are telling fundamental human rights that I will harass you in the first place. How? So these are realities that we need to face, and the industry really know that we have a lot of cheap money out there. Thank you.
All right, thank you so very much, Shegun. I think let me begin to tease out the questions in the Q&A chat so that we can make this robust. In another 7 minutes thereabout, we also, come back to us on a few follow-up questions. Now, there's a question that one of our attendees asked: what happens if the account of the borrower, let me say the accounts, plurality now, do not have sufficient funds for the outstanding obligation to the lender? So what will happen? I think I will come back to Mr. Chibuzo is here with us, because I can't see Mr. Obugo on the platform right now. Maybe you will have to attend to that, because you are also a frontliner among the architects of this policy.
Thank you, Dr. Adedipe. The simple truth is that, like my director mentioned, he showed a slide of volume triggered count, volume triggered value, and then recovery. The GSI has never guaranteed any bank that it will recover money. If there is money to be recovered and they meet the criteria for the GSI protocol, the money will be recovered. If there is no money in the account, there's no money in the account. The GSI cannot put an account into debit, and the GSI cannot put an account that's already in debit into further debit. So I think that probably clarifies that question fully.
Thank you so very much. Now, maybe I will take one other question that seems similar to that. Now, what happens in the case of, maybe I should put two of them together. if the customer in question has joint accounts, how does that, how is that handled by the GSI? And also, where people do fraudulent transfers, once they know the GSI has been triggered, before it impacts the accounts, the possibility that people can move funds. So how do we deal with such matters? There are two of our attendees that ask those two questions: joint accounts and those that move their money when they know there's an impending impact of the GSI on the accounts. I can see a smile of Mr.
No, it's an issue that maybe it would be nice to put a bit of perspective on how much work that was done on the GSI. It took almost a year to even conceptually agree whether it's even possible to even do this before the technology even came to support the possibility. And the extensive UAT that was done with the banks, and I must appreciate First Bank, they were quite helpful in providing the test environment to flesh out all this in a test environment and some elements in the life. The aspect of the joint account, we're aware that there may be two or more persons that have an account, to the extent that at the time they opened the account, GSI was not a clause in that account. So if you go back to slide number, just a quick one. On the slide that talked about the post-note debits, and we gave about 4 circumstances. I think that's on slide number 11. We mentioned that the joint account is a lien. What we've simply done is the interim, the bank is required to tag the account with the code the GSI will recognize and will not override the account to debit it for now. Subsequently, we are looking into the possibility of reverting to account opening to deal with that lacuna. So the whole idea is that wherever the money is, just be mindful of who you are having a joint account with. And if he borrows and if you are aware or not aware, probably at the point of account opening, you would have consented to the fact that it is a GSI and it impacts your account because one of the BVNs associated with a loan in default in another bank, you run the risk of the account being impacted. The other question on fraudulent or notice, the aspect of if a customer knows that he will default, well, it's only the customer that knows that he will default, but the customer does not know when the bank will trigger. The bank exercises the liberty to trigger when it deems fit, provided it meets the criteria for the GSI protocol. A loan can jolly well run for 2 years and there are no issues. So let's not be fixated on the 90 days. It's neither here nor there. All we've said that whenever there's a default in the life of that loan, there are requirements that may fit. The essence of the 90 days, just to provide some clarity, is that there are a lot of instant loans going on these days. So we are trying to make sure you don't give a 1 week loan and 2 weeks later you debit. That in itself does not even meet the requirement of prudential guideline at the minimum. So you can't even do it if you wanted to. So that's the aspect of the joint account and the giving notice. Like I think some of my panelists have already mentioned, there's a limit to how much you are going to take the money out of the system and not eventually bring it back in. The bank will never tell you when they'll trigger once you have met all the requirements, which includes asking you to repay and all the rest of it that go on, which are all standard banking practice, really. So we're not reinventing any wheel here at all. Thank you.
Well, thank you very much for that. Now, there's another question here that perhaps the legal luminary will help us address. One of our attendees asked a question that what happens if the debtor goes to court on this matter after the GSI has been triggered? One of our attendees wants to know what the bank can do.
Well, I mean, that's the point I made, that you can go to court. Unfortunately, our court system is ponderous and inefficient, so you can keep people in court. But if we introduce into the guidelines a dispute resolution mechanism, which is a precondition to going to court, that solves a lot of the problem. In other words, you can't simply just go to court until you exhaust the internal mechanism that has been created to resolve that dispute. So the court then acts as a superintending court to make sure that that mechanism follows a due process. That is one way of actually dissuading people from going to court. So we need to have that. The other point that I would say to Mr. Chibuzo Anthony is this joint account system. That's a complicated one. The way it's been dealt with in the normal courts, normal cases where you have a judgment and you go and execute upon an asset that is jointly held, you can do that, but the person who is claiming to own part of that asset, the body now relies on him to come and prove in what circumstance he owns that asset and why he should be taking that asset away. Because that's where the property issue will come in, when there's a joint account and you then immediately attack that account. I'm happy they've done it in the interim now, which means you flag it, and that flagging can give you that opportunity. So I think it's one, Mr. Chibuzo, we need to look at very carefully so you don't run into trouble.
Just to, if I may, we're aware largely why even the aspect of the corporate is taking a bit of time to come through. We are quite mindful. It's not a case of a knee-jerk reaction to what banks want. If that was the case, we would have been done a while ago. The pressure has been there for a while, taking some time to be sure that it meets all requirements. If you notice my director's presentation, most of the time was actually spent on the safeguards, because that in itself is to demonstrate that the integrity of the system is not at stake. And depositors don't wake up and suddenly money start missing in somebody's account. So even if beyond all the safeguards we put in there, if you go to the sanctions regime, you will notice that it's actually very sequential and meticulous, deals with each and every possible failure point that we have in the whole GSI protocol. And we can assure you that all banks are aware. And if you look at the sanction regime in terms of the monetary side, you see that, for example, you shield an account incorrectly, the penalty is what you are shielding, not what GSI is looking for. So at the end of the day, the whole idea remains. It's getting a bit to a point where you cannot owe bank A, and then you have money sitting around all over the place, and then their hands are tied, if you put it in that perspective. But I do take your point. It's something that we are very much aware of. That's why we said it's in the interim. Once we find a solution that works, it will then be applied to the extent that it doesn't become conflict with any non-legal precedent. And like my director also said, we are also making sure that any account that holds value in the regulated space will be impacted by the CRMs, by the GSI.
Thank you so very much. We still have quite a lot of questions, but let me take this opportunity to recognize the office holders of the Charities of Bankers of Nigeria who are with us on this platform right now. The first Vice President, Dr. Ken Opara, FCIB, and the second Vice President, Professor Olariwaju, FCIB, the National Treasurer, Mr. Dele Alabi, FCIB, and of course, our very much loved past President, Otumba, Mrs. Debola Oshibogun, FCIB, also present with us at this dialogue. Thank you all for being a part of this. Even though, yes, you are the host, so to say, but we're also happy to have you here present with us. So we proceed with the questions that have been taken from the Q&A box. There's this other question that says, how does the GSI affect guarantors? So are we looking at that perspective? I can see again a smile on Chibuzo's face. Now let's take that also with this other one that says, how do we deal with the issue of integrity, where there's a collusion between a bank and its borrowing customer to avoid a trigger? So I think,
okay.
Yes, let's take those two. Yes.
I assume I'm speaking? Yes.
Yes, please. Yes.
Okay. Yes. Yes, you are.
On the aspect of guarantors, it's a feature that we have. It's a feature we are fine-tuning. We're simply following practice. If somebody has stepped in to guarantee a loan, he has an obligation towards ensuring that the loan is resolved or repaid at the appropriate time and the rest of it. So we are not making things up as we go along. I think that's important to clear up now. We are looking into that, and it applies more on the corporate side. Again, why the corporate side is a bit complicated because of the limitations of shareholders, directors, and all the rest. So we are very much aware of the legal impediments in that space. But at the end of the day, for example, there was a point I raised earlier in the question. I think it was our son that mentioned in the aspect of someone claiming he doesn't understand the implications of the GSI. Yeah. We can mention upfront that for corporate loans, we haven't decided the threshold, or we have, when we say we, again, sorry, when we say we, don't mean us and CIBN, we sit down and huddle and come up with these things. We actually engage quite effectively with the operators and even seek the comments of users as well, especially from our consumer protection perspective. So there are a lot of perspectives that will bring into play, all underpinned with our legal. Now, the aspect of the not understanding, for the corporate side, we are looking at the possibility. It's probably a new thing here, but I think it's standard across in other clients, of independent legal advice. Because you cannot, at the time of taking the loan, really, I mean, you're all know all and everything else and all the rest of it. When it's time to repay, you start claiming you didn't know what you signed. So we're looking at the possibility that the independent legal advice, a separate document, probably will come into play, which, I mean, our dear lawyers have their MBA stamps on it these days, will certify that he has explained to him what it is. So, I mean, like you said, after the fact, you go to court, it becomes very clear it's really more of mischief than anything else, rather than you claiming that you didn't know what you signed under the applications or what goes with it. The second question was, what was the second question? Collusion of integrity. Collusion. Sorry? Collusion. Oh, yes. Look at it from this perspective. The trigger is from the lending bank. Unless it's the lending bank staff that will tell the customer, we are about to trigger you, then the chief risk officer doesn't know what he's doing. Because at the end of the day, it's the chief risk officer's responsibility to determine the status of the loan based on all the parameters available to him and the behavior of the loan and all the efforts being done. So the credit risk administration function in the bank basically owns the process rather than more of an account officer thing. If there's any notice that the customer is aware that something is going to happen, I mean, like the customer might have an inkling. Over time, everybody gets to understand what's going on, really. But he might have an inkling what may happen, but may not necessarily know when exactly it will happen. But that trigger function resides with the chief risk officer function. Thank you.
Thank you very much. Now, one other question here that looks interesting is in context of the pandemic, the affecting businesses and borrowers. This attendee wants to know whether the GSI can be triggered at the point of restructuring of an existing facility that is deficient. That is one. Can it be triggered at loan restructuring? And then there is another one I picked out here, and that is of course directly to the CBN. This attendee wants some clarification on the amounts recovered with the triggered GSI so far that we mentioned earlier on. So perhaps also we direct this to the CBN as well. If two banks are owned by the same customer, can two banks trigger GSI at the same time? So let me leave those three, then I will come back to our other panelists.
Okay, thank you, Dr. Dedikwe. Restructuring and triggering, I think that would be an act of bad faith on the part of the bank. Just plain and simple. If you're in negotiations with someone, that's why we provided for, in the event of arbitration and it's ruled against you, there's a penalty for that. So we're trying to, it's not a crime to borrow, and it's not a crime that things are difficult for you in no genuine sense of the word. But the whole idea is that I think Mr. Olivier also mentioned that the fact that there's always an ongoing dialogue. And in the guidelines, we clearly say that it's not the first result. And the aspect that was mentioned about the collateral as well, being at the tail end of it, all that is before, because the process of calling on the collateral is actually a cumbersome process. So we're saying if there are other near cash things available that might resolve the circumstance, then you can take that option. So it's very unlikely, and we can assure you that we'll frown greatly against it because the customer will have evidence that there's an ongoing conversation to the extent that a loan is being restructured and then you trigger, just an act of bad faith from our perspective. Amount recovered, I'm not sure what the question is seeking to to unravel. We gave the statistics. We are not the owners of the loans. We are not the triggering party. We are not the customers. We are simply providing a platform, a credible platform that has rules embedded in it for that to happen. So the banks that have felt they have met the requirements have triggered, and we have a view on all the triggers that have happened, the accounts impacted, the reasons some accounts were not impacted. And one of the first things to do really is we already have the list of the banks that posted some post-no debit. Is to go and check whether those post-no debits are actually genuine in its nature and underlying circumstance. So it's a very clear process, and in terms of the trail of the protocol as it goes through the process, it's available even for the bank that triggered to view if they feel they want to dispute any of what we've seen. And the bank that shielded, you can show what the account, what the balance was when they got there, why you refused the account to be debited. So these are very clear protocols that were done at UAT. So there can't be a case of a bank saying they didn't understand what was happening. Every bank went through UAT for this GSI protocol and signed off on it at the end of the day.
Let me...
the last comment about two banks.
Yeah.
Well, I don't know how to answer the question other than whoever that goes through the door first enters the house.
Yeah, exactly.
No, let me attempt to answer that question, Doctor.
Okay.
And a few other comments made by Chibuzo. If two banks, and that will happen very often, if your technology is sophisticated, you will find out that once the trigger has happened, it will be impossible, and then there will be a method by which there's prioritization. These guidelines have something of that nature. So your technology will deal with that issue, because the first trigger, it will go to reduce the indebtedness of the first bank almost immediately. So you shouldn't have a situation where there are two notices almost hitting the same at the same time. That's the first. Now, the question of whether that is the right person to go on, that's a different question, but technology will solve the first problem, okay?
That's right.
The other point is on the question of guarantee. That shouldn't create a complicated problem because it is a consensual agreement. So the guarantor would already be aware that is almost giving a cash collateral which can be debited almost immediately. It's almost doing that by guaranteeing that, because it's a contractual thing. This is not necessarily statute. That is why all the parties have entered into a contract, all the stakeholders. The third point, Chibuzo, is a very interesting point. It's not so much bad faith. What has happened with COVID is that risk, which was ordinarily resting on one party by the contract, has been reallocated by things that were not within the party's control. What other countries have done is to introduce a business continuity plan. So where obligations arises, take for example, airlines that have received monies into the future, events planners, all types of contracts, bonds that were going to be matured, because of course, you know, when a bond matures, you must meet that date. But unfortunately, during the COVID, there were defaults. There was now legislation introduced to say we're going to reapportion this risk, and we have an assessor who will come in to look at what is just in the circumstance between the parties. I have sent a legislation to both the Lagos State Attorney General and the Federal Attorney General to assist this process, because other countries passed a quick law. It's called the Business Continuity Plan. I would suggest that the central bank does the same thing. It's not so much a mischief. It's just a question of who bears risk under this circumstance that was not anticipated by the parties in the financial sector. Thank you.
All right, thank you so very much.
If I may,
now, okay, yes, Chibuzo, please.
Just to further down what he mentioned, we anticipated such a circumstance, which is why we had the regulatory measures for the banks. Again, you see, we are not in a different planet. Let me put it that way. But to the extent that the lender, we are saying, we know there will be struggles with those that have borrowed. Now, the aspects of prudential that the forbearance we are talking about is really not to make it the burdens, to reduce the burden of provisioning on the bank, restructure the loan. So that's what America is going to be bad faith. You can't restructure a loan because we are saying not restructure for 6 months or 9 months. I think if you look at the criteria, the banks look at the criteria, it was quite generous. And the whole idea is that the impact of this is not just 2 months, 3 months. It has a long effect, a long a longer term effect. So it's not a case of the person coming back in another 90 days or 180 days asking for the same request again, based on the circumstance, because this impacts cash flow end to end. So just to confirm that was the underpinning of the aspect of the regulatory measures to ameliorate impact of COVID-19, which was on slide 6. Thank you.
All right, thank you so very much. Now, because we are constrained by time, I want to acknowledge at this time that we have some other distinguished members of the Council of the Institute also present with us here. And I want to say a very big thank you to you for being a part of this. And also we have viewers from the USA, from UK, from Canada, from France, from South Africa, and Kenya. And of course, we have Mrs. Tokumbo Martins, FCIB, former director, the Central Bank of Nigeria, also live with us from USA. So we have quite a distinguished audience here on this platform. But unfortunately, because of time, we have to wrap up at this point. But for those whose questions were not directly attended to, 2 things we say here. Number 1 is that you will get the communique of this particular conversation as promised earlier by the President and Chairman of Council, and also the slide presentations made by the Director of Financial Policy and Regulation, that is Mr. Kevin Amugo, as well as the slides shared with us by Mrs. Margaret ADVOCACY. So we shared these slides, and then of course, for the question that we are able to attend to, we'll find a way to provide responses to them. I've already done that to some on the Q&A box directly while the session was going on. So let me, on this note, summarize what we have done, not to spend a lot of time on that, but we have a policy that clearly all the stakeholders believe is a welcome development in the Nigerian banking and finance space, and also good for our economy. And looking at it also from several perspectives, whether as from the policymakers' perspective, or from the operators or the bank customer that will be impacted, and even the general economy, relating that also to the sustainable development goals, which the president made reference to in his opening remarks. Clearly, this is a policy that will go a long way in changing not only the credit culture, but begin also to expand the credit space and also impact the economy and indeed every Nigerian business and individual that will require credit support from the banking system. So I want to, on behalf of the President and Chairman of Council and the Council of Chartered of Bankers of Nigeria, as well as the Registrar CEO of the Institute, say a very big thank you to Mr. Kevin Amugo, our keynote speaker today, and to our distinguished panelists, and starting with Dr. Adenuto of First Bank, who was ably represented by the Group Executive and Chief Risk Officer of the bank, Mr. Shekwali Bioshu. And of course, also appreciate the National President of NASIMA, who was also ably represented by Mrs. Margaret ADVOCACY, and of course, our legal luminary, Senior Advocate of Nigeria, Mr. Osaro Edohime. We really appreciate all of you for the decisive contributions you have made, and we also look forward to having you join us in subsequent dialogues. And we believe very strongly that when we invite you, you will also not turn us down. On behalf of the President, therefore, I want to say a very big thank you for the opportunity I also was given to moderate this conversation. It's been a very enriching one and very insightful. I see the President is here, maybe to say a word of or two before we close this session. Mr. President.
Thank you very much, Dr. Biodun Adedipe, for managing our time very well. This is just a little bit before 12. Thank you so much. I want to appreciate all the panelists. Thank you for the well-delivered insights. Thank you very much. I think we are better educated or learned more than when we came here. Son, don't mind me, because it is said that only you people are learned. We are ordinary educated people. I think that we've learned much more than we knew before we came here. And I want to appreciate my past presidents that are here. Thank you very much, Ma. My auntie, Otumba, Mrs. Debola Oshibogun, FCIB, past president. Thank you very much. I want to appreciate my office holders and the council members that are here present. I appreciate you all. I can't mention all of us one by one. I just want to say once again, we are better educated than we came, and we appreciate Mr. Kevin Obugo, the SAN, the national president of NASIMA. Thank you for sending a powerful representation. Thank you also, Mr. Chibuzo Anthony Efobi, for standing in for Mr. Kevin while he exited. He had told us before. And the National Secretariat and CFS, we say thank you very much. Very soon, I believe, I'm speaking the mind of the council, office holder, and the management that we will yet see us with the next series, the number 4 in the series, very, very soon. Once again, thank you, and God bless you all. Over to you, Dr. Biadun.
Okay, thank you very much, Mr. President, for the wonderful closing remarks. So a very big thank you to our panelists and attendees. We appreciate you all and look forward to having you at subsequent events of the Institute. So do have a wonderful rest of the day and see you next time. God bless you all.